are live in the studio today with Nathan and with Lloyd, and we are talking about investments, your investments. Today we're going to be talking about mutual funds. So you know the drill. As you know, we cover important topics relating to your investments. Today we're going to be talking about mutual funds. All right, Lloyd, Nathan, you are up first and foremost. For someone who hasn't heard about what it is, let's just clarify right off the start. What is a mutual fund?
A mutual fund is a financial vehicle that people invest their money in and buy large variety of stocks and bonds in them. So it allows people to buy a variety of stocks within a mutual fund. Not just one, but maybe, and a lot of them are as high as maybe 150, 200 stocks in the one mutual fund. So it gives you a variety of stocks that they have in their mutual fund.
So would this be something that I would call, if I had a diversified account? Does that make sense? I don't know.
You can diversify with regards to different mutual funds. But usually this one type that they have within the mutual fund is all the same, or same quality of stock, whether it be all equities, Canadian, or all U.S. Equities, they'd be all the same.
Okay, so let's even rewind there. What does that mean for people? So it's all Canadian, all U.S., all equities. What does that mean?
Well, what that means is there's different ways that you can invest in companies. There are large cap companies, which are they're bigger companies, more well known, like a Coca-Cola, that kind of thing. And then there's smaller cap companies where, let's say they're just starting out, they're new, there's a lot of growth potential.
A bit more risk?
A little bit more risk,
Sure.
Because there is more growth, or there's the downside of them.
They're startup.
They're startup, exactly. But if things do go well with the company, you'll reap quite a bit of profit from that. So there's those types of risk profile type mutual funds where some will invest all in large cap, some will invest in small cap, some will invest in a bit of both. And there's also mutual funds that you can invest a little bit of everything, where they have a bit of bond composure to minimize the risk. And they normally call those balanced type funds. And it's a little bit less of a ride. You don't have the ups and downs as much as you got the bonds to kind of level things out, where a lot of clients like that type of thing. So
would this pertain to how aggressive I am as an investor? Is that where you sit down with your financial advisor and you think, like, how much do I want to invest? Where do I want to put this into the mutual fund? And as you said too, Nathan, maybe you are going after something that is doing very well, or a lot about a larger company versus a startup, which is more of an unknown territory.
I think the goal of the advisor is to kind of make sure that the client is diversified but not taking risk, because so many clients, they say they really like risk, but when they lose a certain percentage,
they don't like risk.
They don't like risk. They don't like risk the same.
I love it. Not so good.
Not so much. So that's why you have to be willing and able to explain all the ramifications of a mutual fund, that it can go down, can go up, but hey, that's the way the markets go.
Okay, so let's go back to basics for a second in terms of a mutual fund. What are the basics of a mutual fund? Just so we can spell this all out, because like a lot of people don't know. If you don't know what you don't know, right?
Well, the basis is that you're pooling your money and you're investing in it, the company. So you're really pooling the money into one mutual fund, and people buy the mutual fund, and that's how it's the basis of it. It's a financial vehicle for buying and diversifying.
Okay. So
and to add to that, I think too, is sometimes there's a specific stock that somebody likes, but it's too expensive for the amount of money that they're putting aside. You can put up to just $500 and own a whole bunch of or have ownership in a whole bunch of different stocks, where if you actually bought the individual stocks, you could only buy one stock of maybe 5, and so you just don't get the diversity if you're to do it on your own, where a mutual fund gives you that opportunity because it's a whole bunch of pooled money that allows you to buy those stocks that could be unaffordable for the amount of investment you have.
Oh, okay. As compared to what would I do on the flip side if I had? Is that in terms of like a share? Am I buying a share, or am I?
If you bought a stock, that's what you would be buying, is just one stock.
Right.
Okay.
Where mutual
Share
funds,
within the stock.
Right,
Okay.
right. You're buying a unit actually in a mutual fund,
Okay.
which a unit is, they take all the assets that they own within the mutual fund, and then they take and minus the liabilities, and that's what kind of gets you your unit price.
Okay, so you're
and
getting
those
better bang for your dollar, basically,
Right,
is what you're saying.
right.
Yeah.
Yeah, you get more exposure for especially for those small investors.
and it's supposed to be less risk.
Okay.
Right, because you're pooling with a whole bunch of different
people,
companies
okay.
instead of just one individual. If it goes down, then you're out of luck. Where at least, if you invest in 100 companies and one goes down, at least you got the other 99 to back it up.
Right. Okay, so in terms of mutual funds, are there are obviously different types. What are the different types of mutual funds?
Well, there's some of them here's a few of them. Money market, which is just like a holding. You're just holding it for a period of time because it's not going to get you a big return. There's fixed income, which are bonds and that type of thing. Then there's equity, which we talked about before. And they'd be buying in ones like Canada or US, and they'd be buying in straight into companies. Then there's balanced funds, which would be they would be a type of bond and equity. So they might be 50-50, 60-40, but they will have a split that they will call. And then there's specialty funds, which may be ones that that would invest in REITs and stuff like that, that is just a special area.
Like gold and, if you want a certain sector that you want to be invested in, there are mutual funds for that too.
Okay, so I always feel as though this is something you need to study each and every day to keep up with the trends. Like you've already just named in mutual funds alone 6 or 7 different types of funds. And that's what you do, right? That's exactly what you do, is you keep up to date with this and then translate that information to your clients as a financial advisor.
Right.
Okay, so that's first and foremost why I always recommend having a financial advisor. If we're looking at terms of, okay, so I've invested. I want to ask the question now: how do I earn my return? How do I get a return on my investment?
So you want? Well, I guess one way. So when you invest in a mutual fund, what's actually happening is there's a manager that actually looks after your money through that time, and he picks and chooses the stocks that he thinks that will outperform the market or do well over time, or if for instance, just like a low risk with you have a bit of bond and a bit of equity, well, that manager will help minimize that risk with having, well, I think we need this much bond exposure compared to equity during this certain time period,
And that goes
kind of
back
thing.
to expertise in the field,
right.
and doing your research and knowing that, and relying on that person that you are relying on.
If you were doing it on your own, you likely would not be as successful as the mutual funds for picking the stocks because you don't have the expertise. Second is you let emotions get into it and you buy, or you get the flavor of the day, which is, I've heard about this hot
I've been
tip.
there. Hey, my husband and I have been in that situation, and you get into, and then it did not go the way that it was expected.
Yeah.
And I do believe at one point you did warn me, Lloyd, and said, I don't know if you should. And I was like, no, I've heard it's a sure thing. And yeah, don't listen to what you hear, right? Like, don't
usually,
listen to what you hear.
Usually when the
Except if
investor
you're
hears,
yes.
then it's already too late. So.
That's right. So
To
yeah.
invest.
So like solid, great points here in that when we're coming in terms of mutual funds. What do you think are the biggest advantages and disadvantages in terms of mutual funds, if you had to explain that to someone?
Okay, the biggest advantages I would put down, and there's a few of them, like diversification. You can get diversification where you can't get it from just one investment. Easy access. You can get into mutual funds and out for $500.
Easy, go back for a second. Easy access, you can get in and out for what does that mean?
You can buy a mutual fund for $500.
Okay.
Yeah, you
So
don't need a lot of investment.
You don't need a lot of money
Yeah.
to do, okay.
Yeah.
Professional managed. Like those are guys are professionals. Variety and freedom of choice. So you get to choose all different types of investments. Transparency. They have to tell you what's going on, and they have to give you the rate of return. Liquidity, in that you can sell it and get paid within a week.
Seriously?
Yep.
Oh.
Yeah, and there's a variety of offerings. So that's the main things about that. And some of the disadvantages, it fluctuates.
But so does everything else.
Yeah.
Right? Like it's,
There's a cash drag. What we mean by cash drag is they may hold cash in their cash account for a period of time thinking it's not a good time to invest, but you're still paying your management expense. Some people think it's a high cost.
If it doesn't return or if you don't get the outcome that you're expecting or that they're thinking, and you've paid all that money or that percentage and you didn't get what you wanted, then.
But that comes with any kind of investment, does
Right.
it not?
Yes,
like
it does.
every investment comes with some kind of a risk.
Right.
Whether it be a low or a high or a medium type risk. It's just, again, if I can interrupt for a second, I equate it to like if you were selling your house, you could either sell it yourself for sale by owner, or you could hire a real estate agent.
Right.
And there are pros and cons, I guess, to everything, right? And
exactly
are
right.
you're going to pay them for their service and their assistance?
Yeah.
And that comes with a cost. But did you make more money on the house? Did you get through their expertise? Did you get more return on your investment? So I just equate all of it
Right.
to similar. Yeah. So just one question, as you were mentioning, Lloyd, if they are holding, or maybe you mentioned this, Nathan, if your advisor or the person is holding the money and they didn't spend it yet, what does that mean? Because they were waiting.
Okay, what would happen with a professional manager is they may have it called sitting in cash.
Okay.
And what they're waiting for is they think that the stocks they're buying are too high and they don't want to spend people's money on it. So they'll keep it in cash thinking that, okay, maybe there's going to be a dip. Maybe they can find another stock that's better to buy. But they don't want to go out on a limb and buy something that they don't think is advantageous for them to make a good return.
Is there a time period that they can hold it until, or is it indefinite?
No, it's indefinite.
Because you put your trust
Yeah.
in that person.
Right.
Okay. Okay.
Yeah. And the only other thing that would be a disadvantage is taxes. Because they often have to, like when you sell it, it's capital gains, but they also, it's a situation sometimes that develops is, okay, the fund went down 5%, but I still had to pay taxes because they declared interest, they declared dividends, and they declared capital gains. Well, on your form that you got from them, you have to pay the taxes on that. So that's why sometimes it's a disadvantage.
Right.
But
Okay, because you are paying taxes each
And-
year, and
and
you get that slip from the
Yeah,
from your bank
even though
every
you
year.
didn't sell the mutual fund yourself,
Yes.
there was selling and buying within the fund that you would end up incurring on your tax because it just gets sent to the investor that's
Right.
invested into.
Okay.
So
Okay.
that would be one disadvantage for sure.
But
Depending on, but then if you get in, let's say hypothetically you get into a company at a very early stage, and you said you maybe are buying in at a very low rate, then your percentages wouldn't be as high, would they?
well, there's
I guess it depends.
Yeah, it depends on
mutual
how the
fund
stock
companies
does.
have a certain criteria. They have to be to a certain size.
Okay.
Okay, if you're buying in yourself, like everybody can talk about what happened with the cannabis stocks or stuff like that.
Oh, that's a huge topic right now,
Yeah,
right? Like, because
so-
everybody like you said, Nathan, you want to buy in. Oh, sorry, you want to buy in early and everybody, but by the time you hear about
About
it,
it,
it's like too late.
already
right?
too late
Okay.
usually.
Sorry, I
Yeah.
didn't mean to interrupt, Lloyd.
Yes, and that's why you take emotion out of this, and this is a major thing. Emotion kind of sends people down the river because they start thinking, instead of, not with their head, usually not very well, because they think not at all. They just, what am I going to make? What am I going to lose? And that's when things go awry.
And there seems to be these hot topics, like you mentioned, like cannabis is one of them. And what about all the like online trading? The
Bitcoin?
Bitcoin.
Yeah.
Like Bitcoin.
Yeah.
I heard all sorts of things
Yeah.
about Bitcoin. Do it. And then the person that told me to do it then lost a lot of money and said,
Right.
and I didn't do anything. For once I listened. I listened.
No, those
and-
are speculative trades is what you
Okay.
call those.
Okay.
Because you don't know the outcome of those, and it literally is just an internet thing at this point in time. Whether it comes to fruition, we'll find out. But
Yeah.
Okay. Interesting stuff. Anything else we want to mention about mutual funds before we depart?
No, I don't think there is, but if there is any questions, we're available to answer them. Because
As-
it's always,
I'm always full of questions, so I know if I've got questions, other people must as well. Anything else, Nathan?
no, everything that was pretty much said is good. Yeah.
okay.
All right. Okay. Thank you so much for watching Peaks Money Talk. Another episode. We'll have one more for you next week. Actually, coming up every Thursday is when we air these episodes. So tune in next week. And as you know, we cover topics that are important to your investments here at Peaks Money Talk. We'll see you next week.